you have to look for a great deal. If you're not getting a great deal, don't transact, sit and wait and be more patient. If anything we learn from the days of 21 and 22, patience is a virtue.
So,
And,
friend.
you know,
So the big question is this: how do real estate investors who don't have a ton of free time, don't have access to off-market deals, and didn't start life on third base, how do we conservatively grow our real estate business to support our families, finally leave the corporate rat race, and build a legacy? That is the question, and this podcast will give you the answers. I'm Ed Matthews, and this is Real Estate Underground. Greetings and salutations, Real Estate Undergrounders. It is Ed Matthews with the Real Estate Underground. Thank you so much for joining us today. I'd like to thank you all for all of your follows and your comments and your texts to the show. Keep them coming because that really helps us. It helps us grow and it gives me direction on the types of subjects and guests that you're looking for. So keep that stuff coming. And thank you again. Today, I have Mike Zlotnik, Big Mike from Tempo Family Funds and Syndications. Mike and I were just talking about our kids and having high-end athletes for children. And what that means is we no longer have our own weekends. But we can talk about that later. Mike, thanks. Thanks for joining us. Welcome to the show.
thank you so much for having me.
Absolutely. So for those folks who haven't discovered you yet, why don't you tell us a little bit about you and Tempo Family?
Sure. So I live in Brooklyn, New York, with 4 monkeys and a cat, 4 human monkeys, and my wife. And so we have 4 kids and then a real cat. I'm a real estate junkie. I just love real estate. I'm passionate about this. I actually spent 15 years as a technology executive, and then I discovered in 2000 real estate and invested passively for 9 years, and then became full-time real estate professional fund manager in 2009. Look back, it's my genius zone. I love it. So I'm very passionate about real estate. We focus heavily today on commercial real estate deals. I know you do a lot of multifamily, so we do a lot of multifamily. We love that asset class, but we do also other strategies, open air shopping, industrial, storage. We're also lenders. We have some niche strategies. Commercial real estate is what we day in and day out, and that's it.
Awesome. Yeah. When I discovered you on LinkedIn, it was particularly interesting. It was the blend of asset classes that you pay attention to. Obviously, these days, especially living here in the Northeast, not a lot of really good deals that you see out on CoStar or elsewhere that they really pencil. There are pocket deals that I see that are getting close. For instance, at Clark Street, we haven't bought a deal in over a year. And I don't know what that says. I think that says that we're really picky, but it may say something else. Who knows? I'm curious about what you're seeing in the marketplace in the asset classes that you follow.
Yeah, so appreciate the clarity and respect your patience and not transacting or trying to transact for the sake of transacting. We are the same way. It's not about the volume. It's not about the quantity, it's about the quality. So today we're looking for deep value deals or no deals.
Right.
We either are a lender, which we continue to do, or we got to get into a very predictable or very deep value deal. So what does it mean? This year, we only did 1 deal in multifamily. We're a little different from the traditional operators. We actually capital partner. Well, that's the best way to describe it. We marry money and opportunity. We are not direct operators.
Okay.
So what that means is we seek these jockeys, these people who run these horses, these deals, jockey ahead of the horse. We basically seek guys and girls like you who are deep specialists in your strategy, vertical integration, whatever market, what's a great deal in your market, how to get it, how to market. It's hard to find great deals, but they exist. The industry is most certainly significantly impacted by the higher for longer interest rates. All other things being equal, there's financial pressure on many owners. They financed with floating rate debt. They had rate caps expire. They had a maturity cliff, whatever you want to call it.
Yeah.
There's a motivation. So if there's motivation, there are deals. Now, they're not happening in great volume. Everybody's holding on, survive until 25, survive until 26. People are just holding on. If they can hold on, they think miracle's going to happen. Maybe they will, maybe they won't. Nonetheless, when you're transacting today, you got to see a great deal in my book or no deal. That's it. That's the philosophy. Then you go into underwriting and you got to look at the different metrics. I'm happy to give you some details of what's a great deal to us today.
What's your buy box look like today?
So I'll give you some very specific metrics and people are going to look at me like I'm insane. And then I hear this all day long. People buy. I had a conversation. We just looked at a deal in Tampa that's trading, let's call it mid fives, cap rate, nothing special, nothing exciting. You have almost no spread between the cap rate and the mortgage rate. Those are not great deals. There may be interesting deals if you believe in the market growth over the next 5 years, all that stuff. Deep value deal to me today is what we did in early part of the year in Q1. 9% cap rate on purchase near Ann Arbor, Michigan, 7% financing. It's a floating rate, but it's fixed for 3 years. Basically, you have 200 basis points or 2% positive spread between the cap rate you're buying and then the cost of financing. That's a margin of safety. Going back to Warren Buffett, Charlie, or Benjamin Graham, right? You want a margin of safety. 200 basis points, I think 1.5% would be minimal. 2% or better, you're doing pretty good.
We do the exact same thing. That's our first metric.
Number two, right? I go relative to reconstruction cost. So people talk to me development all day long. I look at the development, I say, I can't get a discount on it. I can't get a deep value. It's cost to build what it costs to build. Maybe construction cost could be a little down with labor being a little softer. You could argue that, but you can't really fundamentally do it cheaper. So on an existing, you can get a steep discount to reconstruction cost. In that example, we bought at $79,000 a door. Reconstruction cost is about $200 a door. Then you have to discount for the condition and age, right? I go look back at the peak of the market. How much of a discount are we getting today off the 2022 pricing? Why? Because it's a metric. It's a comparison. What I do know is that the markets have generally adjusted between 20 and 40%. Anecdotally and mathematically, 20 to 40% is the right range. On that particular asset, that thing traded at $125 a door. We bought $79 a door. It's about 35% off. Right? One of the challenges is I don't really know exactly what the market is today. Transaction volume is low and comps are minimal. So I want to get a discount on the as-is basis, but I can't always establish the market. So I can compare to what it traded at and then feel pretty good about that discount. These are just three really important metrics. That different metrics, of course, on top of this, can you add value through energy efficient improvements and get some utility company reimbursements? Can you do, obviously, your standard unit renovations? And what is your average trend today? On that property, average trend is $1,150 a door. What's the market? And then you could argue, and you got to look at the comps, but you got to have a pretty decent step up from there. This is the classic underwriting model. You still go back and you push rents how much? We like to look at affordability. Like this is suburbs of Detroit. It's fairly affordable. Now, if you go to some other markets, affordability is on the edge. And then you could still argue you could charge $1,500 a door, but what happens with affordability? Can people actually pay $1,500 in that area for these apartments for this type of a product? But the first three are the most important ones.
Indeed, I couldn't agree more. Yeah, I learned this from a friend of mine I met on Twitter. We used to be a little more aggressive when the market was ascending. Looking back on it, it worked out, but it was pretty risky. We would go as low as 1.5. And I was talking to that friend and he was like, what are you doing? You should be at minimum. He was saying 1.9 and preferably 2.0 in terms of spread between cap and your debt cost. And I started doing the math and thought, yeah, I got to stop being a little bit of a cowboy.
I just look at a self-storage deal, and I know your audience is mostly multifamily, but I look at a self-storage deal in Houston Class A properties, and they're buying them at 5 cap and financing 5.75 cap. It's a negative 75 beeps spread. And I said, thank you. Have a nice day. You have to look for a great deal. If you're not getting a great deal, don't transact. Sit and wait and be more patient. If anything we learn from the days of 21 and 22, patience is a virtue. And,
couldn't agree more. It's us old guys that are going to be, so we're going to survive this. So talk to me about the other asset classes. You mentioned self-storage. I'm not invested in any deals at a general or limited partner basis, but it's always been intriguing to me because you look at like traditional multifamily performance year over year is, depending on who you talk to, right around 13%. And I'm going back decades, right? When you look at self-storage, that average is around 17%. And that's, for me, that's really attractive. And then a friend of mine, Brian Tully, has gotten me really interested in flex industrial. And those returns are pretty attractive as well. I'm just curious from your perspective, those other asset classes, is that where your focus is now? Or are you more of a, I'm going to take what the market gives me and evaluate it one by one?
Yeah, these are great questions. Let me start, because we marry money and opportunity. We are capital partners, we are flexible. So we are opportunistic, number one. Number two, we're not big fans of storage because the cap rates are still low. I've looked for years with storage. We still have some old positions many years ago, but beyond that, I can't find a great deal of storage today because the cap rates are too low. Where we are finding really interesting opportunities in industrial, there's a flex industrial and there's also a single tenant, triple net industrial. We love those type of deals. The entire underwriting comes down to underwriting of a tenant. You have a 20, 25-year lease. You have a high credit quality tenant. You have triple net, absolute triple net. You have annual 2 to 3% annual rent escalation clauses. And I compare it to multi and I say, what's the average around the country rent escalation clause? Not escalation clause. It's the average annual increase, right? You try 2 to 3%. You go to Florida, maybe you start arguing 3 to 4%. Right. But in general, 2 to 3% is about what the US.
Yeah, it's a good, solid core holding, right?
Exactly. In industrial, 2 to 3% is absolute addition to NOI. There's no additional cost. The roof goes, the parking lot goes, the fence goes, insurance is up. It's all triple net. It's all paid by the tenant.
Yeah.
That's why we like industrial. We're looking in industrial now because it's so predictable. We also love open air shopping. It's been a huge contrarian play. Years ago, we are on that like 8th deal in that strategy. And I can tell you every single one of them has done well. Multifamily has done the roller coaster thing through the peak of 22. Open air shopping has been no supply. Multifamily got overbuilt in many markets. In open air shopping, there's been fear of building, Amazon effect, and you have very limited supply. So we've seen pretty significant rent growth, healthy. Most of those deals have been financed with long-term debt. Today, really like open air shopping, if you can get a deep value, and they trade at much higher cap rates. So you're talking about industrial deals, we're looking at between 8 and 9 cap rates. Open air shopping, we just did a deal in San Diego, downtown San Diego, purchased at 9.25 cap, on purchase with 84% occupancy, and financed with 6.5 fixed rate for 10 years. Prepayment penalty burns off after 5. Wow. So you're locked into a very strong spread. You have a lease up on that property. That was a very motivated seller situation. It's a great deal. And then you have essentially Starbucks, ADVs, Cheesecake Factory. The difference between industrial open air shopping, multi, and storage is this. Industrial and retail open air shopping, long leases, predictable long leases, right? You go multi, typically 1 year. Sometimes you have a 2-year lease, but typically it's a 1-year lease. Storage is month to month. When times are good, you push up your rents. When times are not good, you have a problem. Storage wars. If you oversupply the market, boy, that's a big problem for the storage industry.
Yeah.
So that's the lay of the land of some of these strategies. We do a bunch of other things. We do recreational land. Literally, we loan money on people who buy land, recreational, and then they sell it or seller finance on their website for guys and girls to run their dirt bike or shoot their guns. It's funny how it works, but we do that. We do a number of other things. I'm not saying there's any right strategy or wrong, but it changes. And if we seek better opportunity in a given market, a given strategy, we can consider. What we love about multifamily now, it's deeply discounted. We just got to find the right jockey and the right great horse, and we're happy to write a check. I mean, that from that perspective, it's a game of patience. And the other really big benefit to multifamily, what I love today, bonus depreciation is back 100%. It cost segs way better than industrial. It cost segs way better than open area. And the only thing that's better is mobile home parks. They say that you could basically, the whole thing, there's no foundation and walls, you could cost seg better. So multifamily is still a great buy today. You just got to find the deal.
Yeah. No, it's exactly why the government put it back in place, because the multifamily market has cooled so significantly due to the interest rates. It's also probably why the president is pounding on the Fed right now to drop rates, because that and home building is a gas engine for the overall economy.
Supply problem.
Oh, without a doubt.
We can talk for 2 hours, but I'll give you a very quick economic theory, right?
Yep.
When you hike interest rates, you kill demand, but the problem is you kill supply too.
Yep.
And to incentivize supply, you need lower cost of financing.
And we're already at a deficit. Yeah, we're already at a deficit because 2008, 9, 10 took out the general contractor class, basically halved it. And those people, most of them didn't come back. And there are a whole lot of people who used to build apartment buildings and housing, single family houses who are now own Starbucks and are real estate investors instead and buy land and don't develop. It's literally in our town, the biggest, probably one of the biggest in the state builders. He hasn't built a house in 10 years.
You need low interest rates, obviously, cost to finance, and you got to give them some tax incentives and other incentives. Northeast has been interesting. If you actually look at historic data, and I looked upstate New York, and I have some family upstate New York, growth rents have been super healthy in Midwest and Northeast for the reasons of limited supply. People build in Florida, they build in Texas, they build places where it was attractive to build. Here, we have very limited supply.
Yeah, and that makes sense because the population in that Sun Belt to Texas out to Arizona, that population has exploded.
Affordability is another big issue. When affordability gets out of control.
Yeah. So storage, open air, multifamily, obviously. What other asset classes are intriguing to you?
Stay with us. We'll be right back.
A motivated seller just filled out your web form. If you call back within 5 minutes, you're nearly 4 times more likely to get that seller appointment. But delay your follow-up by even just 10 minutes? Forget it. You're toast. Ella Vista Connect calls that lead back in 60 seconds, qualifies them, and schedules your meeting. Find out how much slow follow-up is costing you. Free calculator at ellavista.com/underground.
I'm not a big fan. I'll just tell you what, this is a whole theory, but I really have a box and a don't buy box. So my buy box is really no new construction in general. But we're talking about being a bridge lender. We've done some bridge lending with the cross collateral, additional collateral. I don't mind being a lender, let them build. And if they put up good collateral and they have a problem, okay, we have collateral.
Right.
Hospitality, not a huge fan, although it's done relatively well in the post-COVID world. I am concerned sooner or later we will get into a recession cycle and hospitality might just slow down, right? I'm not a big fan of what is operating business masked as real estate. People talk about they love Airbnb, hospitality. It is an operating business. It's real estate, but it's operating business. Then you go into, people talk about senior living or independent living or pool care, senior living facilities.
Yep.
Heavily operating business. I don't know the business. It depends very much, not on real estate, but on ability to operate. Storage is a little bit of that operating business. It's real estate, but it's also heavily operating. That's why I'm not crazy about storage, and the cap rates are too damn low to make it interesting. Office, don't really like office for the fundamental problems, right? People redevelop, they try to redevelop, but it's hard. From what I talk to, redeveloping an office building into anything else. And again, development or redevelopment, I would rather stay out of it. So what I know is a buy box. Devalue multifamily, devalue open air shopping, industrial, and debt. Mass debt, recovery debt on existing multifamily assets. So from that perspective, give me a good project. If you need some liquidity and we can come in the right position, we'll look at that.
Yeah, right on. So it's interesting, right? You're clearly out ahead of progress, right? Because manufacturing, for instance, is moving pretty rapidly back into the U.S., at least components
Industrial
is ripe for that.
There's additional incentives for domestic manufacturing will continue to be. And that's what we love, especially industrial manufacturing, not industrial distribution data centers. Data centers are beyond cool, but it's a hot trend. And they cost a fortune to build, and AI is growing at a rapid pace. The problem is you need to build brand new. It's built to suit. It's very expensive, and people are dumping money, and we can't even compete on the scale they're building. We're a tiny fish in a humongous pond. So we try to play in the opportunities where we can actually be a reasonable sized player and avoid these $500 million projects.
Yeah, played, because you can't compete. There's just our net asset value is their rounding error.
Exactly.
So in terms of the deals that you're seeing coming across your desk, is it, if I'm hearing you right, it's a lot of retail open air and a lot of industrial and a whole lot less of the other asset classes right now? Yes?
What we are is, again, we are a capital partner. We have strong relationships, opportunities. So people talk, I got to go through 1,000 deals to select 5. We don't look at 100 deals to select 5. We look at 10 to select 5. And the reason it's like this is because we get pre-screened deals that are either close to being under contract So what we see is we maintain open communications with our close relationship partners, and we try to understand what's coming up. And in some cases, we even use this technique. This is a very powerful and very simple technique. Some folks already funded closed deals, but they need liquidity for the next deal. We will come back and we'll look at the existing deal that they recently funded and closed and say, okay, we'll step in, we'll buy out your position or a portion of the position if we like the deal. So we are opportunistic. We're not trying to nickel and dime and come up with crazy discounted offer. But if they got into a great deal from the start, this backfill concept, I really love it. As an investor, you don't have to fund a new deal. You could pick up a recently closed deal. You can analyze, you can see how it's doing. And if it's doing well and somebody needs liquidity, you could do it that way.
Yeah.
So it's not a heavy volume, but we are talking to a lot of our relationship partner sponsors and trying to understand what they have coming up. And these discussions are, what I would say very recently, things have gotten a little bit less volume-wise. In other words, people are not seeing the one big beautiful bill pass, depreciation is back. People expecting interest rates, maybe a little more bidding activity. But we're sitting waiting for these strong deals. And if they don't happen, it's okay.
Yeah, it's going to be fine. Because there are other asset classes. And I wholeheartedly agree with your approach. Okay, so let's get into the lightning round, the final five. I'm curious about leaders like you who have done very well. And from a financial perspective, things are taken care of, right? You're not struggling to pay your mortgage if you even have one. Car payments are either handled or non-existent. The kids' college educations are either they're lining up to get major scholarships like your kids or professional athletes like your kids, or there's a college fund sitting there waiting for them to utilize. And you get out of bed on Monday morning and you go charging headfirst into your office. And so to me, that's purpose. And so I'm curious, what gets you out of bed on Monday morning?
So I have a whole simple theory. I just like to operate in a genius zone. I love what I do. So to me, it's not work. And what is genius zone? It's something you're good at, something you really love, and something that makes you money. That's that simple. I spent 15 years in technology and I was making very good money. I was very good at this, but I wasn't motivated. I love real estate. I'm a deal junkie. I love looking at deals. I'm a chess master. So to me, all this analysis is just fun.
Right.
I don't know what else I would do. I'd go bored, right? That's what gets me out of bed. I just enjoy what I do. I don't know how to describe it. It's almost like some people are motivated by a huge payday. It's almost like this. It's 40X, a book, 4 disciplines of execution. You put in the inputs, the outputs will work out. So I just love getting the deals done, putting it into the right framework, and then magic happens years down the road.
Yeah, I think if you do a lot of the right things in terms of your due diligence, in terms of picking the right partners and all of your process, the money follows, right? It's not a matter of getting out of bed and saying, okay, I'm going to make $1 million this quarter. It's I'm going to go do 3 deals that need this criteria. And when I find them, and I will find them, when I find them, we're going to attack. I'm also curious about the mentors you've had along the way. You and I actually have very similar backgrounds as recovering technologists. So I'm curious about the mentors you've had over the years and what's the best advice you've ever received and who gave it to you?
Yeah, it's a great question. And a lot of my mentors, I call them book authors, right? So I read a lot of books and I actually listen to a lot of books. So I love Howard Marks, Market Cycles, obviously Warren Buffett, Benjamin Graham, Ray Dalio, huge fan, right? Follow a lot of his theories. And I do have some old friends from the technology world that were sort of mentors. I literally reconnected one of them out of Austin. There's been so many conversations and advice given. I don't have a single one that's been so transformational. It's just more of, I think the biggest thing that I've learned from all my mentors is a learner's mindset.
Yeah.
By far, what I can tell you is being humble, humility, and a learner's mindset will get you through everything in life.
Indeed.
And honestly, one of my favorite books is John Maxwell. Sometimes you win, sometimes you learn, right? So just constantly back to chess. I literally am writing a new book right now. One of the chapters in the book, one of the descriptions that I'm talking about, investing is like chess. You learn in investing like you learn in chess. How do you do that? I'm a chess master. I spent years practicing. I analyze my own games and games of world-leading chess players. Yep. You look at what they did, how they did it, and understand the purpose, and you understand the errors and your own errors. Same thing happens in investing. We're not perfect. We're going to make mistakes. And as long as I learn my lesson, I am happy.
Couldn't agree more. And that actually leads me to my next question, because I agree that we learn far more from our mistakes than we do from our successes. And so I'm curious about a professional decision you've made over the years that you look back now and go, wow, I'd love to have that back. And what'd you do about it?
Because of my humility, I am not proud of this, but we did a bunch of deals in 21, 22. It is what it is. And these were multifamily deals.
Yep.
I go back, and I had a conversation with my investors who yelled at me, literally just said, Mike, you're such a smart guy, but you're also such an idiot. Why didn't you see these interest rates rising so fast? And I humbly acknowledged I should have thought better. I should have really thought about this. I said, listen, the Fed kept their interest rate policy for almost 20 years. The biggest hike they did from 0 to about 2.5 in whatever, 18, 19. And then they pushed it right back down. If you look at the president, it was difficult to see market changing that much. It wasn't just me, it was the entire market who misunderstood, misread.
Me too.
At the same time, I know people who sat on their hands in 21, 22, it did nothing. And because they were selling deals, they were clearing out, they were liquidating. So I bow to them. They're the wise men, and I'm that idiot. There's an expression, fools learn from their own mistakes, and the wise men learn from the mistakes of fools. So I'm the fool who now is learning from my own mistakes. 21, 22, we did do the deals, and we're fighting now to make sure these deals hang in there. Not everything will survive. I'm completely unhappy about some of those situations, but we are persevering. We're talking to our investors. We're very open, transparent about it. All we can do is do it with complete openness and transparency. But is it a mistake? Looking back now, hindsight, sure, it was a mistake. What did I learn? I didn't quite study enough of market cycles. So after that, I read Howard Marks, Mastering the Market Cycle, and tried to understand that there are cycles, and you better understand where you are in the cycle.
Yeah, I think that we can all understand that mentality in terms of what you saw versus what happened. No one has a crystal ball. And I certainly didn't see interest rates rising as fast in as short a time as actually happened.
I have a good phrase for it, like the movie, Fast and Furious. So the Fed hiked Fast and Furious. It's not just the absolute 5.25%. It's the speed. It's going from 0 to that level. You went up 40, 50x. That's the crazy part.
Yeah, it's nuts. You mentioned several books during the conversation. I'm curious about who you're reading now. Who are you paying attention to?
So I am reading for the third time now, Ray Dalio's How the Countries Go Broke. Obviously, I've reread Principles and many things, go back and reread. So what I do with books is this. I don't consume volume of books. I sometimes will go again and again until really it sinks in. As I was listening to one of Ray Dalio's, it sunk to me one of his principles. If you're not worrying, you should be. And if you're worrying, you shouldn't. Some of these concepts are, if you're paying attention to something and you're studying it and you're preparing, you're probably okay. And if you are completely complacent and ignoring it, you're not really understanding risks. That book, Michael Dell's Win and Play Nice, something like this, it's a recent book. Periodically, I'm coming back to Howard Marks and really trying to spend more time understanding risk. Risk is the most difficult thing to understand. So not only before, but often after, right? You do a deal and then it works out or it doesn't work out. And if you judge based on the results, maybe you didn't see the risks. You still don't know what it should have been. But it's a mix of books. I love a couple of other books I'll mention. This is a good recreational book, but it's also about the wisest investors of the world. Richer, Wiser, Happier. That's a great book. It actually studies people like Charlie Munger and some other greatest investors in the world. There's a whole Audible library that I go through. I'll go listen to 3, because I've listened to this book so many times. I will go back and listen to 1 or 2 chapters and then switch to another one. You could continue to learn a lot. But I do watch old movies again and again as a joke to see if anything different is going to happen.
It's interesting. I have my favorite books that I read every year. I also have my favorite movies that I see whenever they come on. And in both cases, I always see something new. Even if I've read the book 3 times, I always find something new. And likewise in a movie, if I'm paying attention and it's not just background, you always pick up on something, right?
Yeah. So the movies are purely entertaining because it's visual. Books and all, I consume content way better listening than reading. Some people love reading and like certain data and charts. Yeah, you're better visual. But
Yep.
concepts, Audible.
Yeah. And actually, I cheat. I have the Audible playing in whisper mode and I read it on my Kindle. So I'm a very active reader because I'm a rather slow reader. So I tend to be more active and I take notes and highlight. And yeah, there are several books I read every January, no matter what.
I think one thing that's completely wrong about our educational process is different people learn differently.
Yeah.
And if you know what works for you, and same thing for the kids, sometimes they just tell them, this is how you got to learn. But not every kid learns the same way. This is really important. And now in the age of AI, I think there's going to be a lot of learning without some of the old doctrine and more of by some of these AI systems. It's another discussion.
And something I'm very passionate about because I have revived my old programming chops by simply having conversations with ChatGPT and Claude. I need you to teach me Python as if I'm a total and complete beginner. Let's start. And I've been having ChatGPT, I'll have ChatGPT teach it, and then I'll apply it in Claude and see if I learned it. And then I'll go back and forth. And it's, yeah, if I'm not careful, I'm going to get sucked back into the technology world, but I'm not going to allow that to happen. It's more automation first stuff here that we pay a lot of money.
You're doing it for fun.
It started as fun. And now I'm starting to see where we can automate our business. So it's spurring us to solve bottlenecks in our business with this type of technology instead of throwing a human being at it, which is what we used to do. And yeah, so far so good. So still early.
My only feedback would be you're a leader of your business, and it's another great book. So this is very important. So as a leader of the business, you have to really think about leadership and CEO.
Absolutely.
Trey Taylor, a CEO does only three things: people, culture, numbers. That's another great book.
Yep.
So whenever you have an inclination to go back to programming, I would say find a kid.
I'm doing the PRD and then I'm handing it off a project to a member of our team that she's building the Excel prototype before we build the software. But yeah, no, I'm not the one programming. I just want to know enough so that when I have that conversation with the kid in India or wherever he is, that he's not snowing me and I can figure out that he knows exactly what he's talking about. That's really where I want to get.
That's you're learning for the sake of being able to be on the intelligent level rather than the baloney story.
Right. And instead of watching Netflix after dinner, I'm doing this, right? So in terms of how you operate, I'm curious how you define success in your life.
It's tough to be, some people measure net worth, some people measure, I don't know, how much good you've done. I've never been an exact fan of these precise measurements. I've grown up around the family. So to me, I just want to see happy, successful kids. At least this is a priority to me. Of course, I want to do good to whatever degree I can, but they say charity starts at home sometimes. You really have to make sure your kids are. So to me, for kids, I'm just making sure they're good kids, they're successful, they're enjoying, they're productive. I never curse, almost never curse. If I hear one of the kids will start sleeping something, I tell them, listen, do you hear mom and dad curse? I said, people curse all the time. And so I don't know if this is a definition of success, but it's just like my first duty as a parent to make sure the kids are good and successful. I don't measure success purely in the financial terms. Once you feel that you're financially independent or happy, it's just a score, right? It's all about operating. My success is operation in the genius zone. If I feel like I'm operating in the genius zone, I feel great. This is it. This is the winning. This is success. Can I help other people while I'm doing this? Can I be happy? Can I be productive? The team of people around me, I always think about people, culture, numbers. Can I impact and influence other people in a positive manner and make a positive difference in their life? And if I'm doing this, I feel satisfaction. Like I'm really coaching other people, helping them, and they're successful. And it's giving me satisfaction. I feel that's a positive difference I'm making.
Couldn't agree more.
Exactly.
All right, Mike, what do you enjoy doing?
I walk a lot. I walk like a madman. Every day, I literally have a meeting booked every day to go for a walk, a specific hour. Walking is the best exercise by far. My wife says, go to the gym. I get very bored. I don't go to the gym. I will literally I can walk for an hour and a half. Can even sometimes more. And the beauty about walking, you can listen to books while you're doing this. You can listen to a podcast. You can do a lot of other things. So walking I like it. I still from time to time go back and play some chess on chess.com. And we travel quite a bit. My third girl is a professional figure skater on a synchronized figure skating team. And I'm on the road, competitions, trainings. So we spend time basically being in her life. And other kids, they have their own stuff. So I don't know what else to say. There isn't that much time left after you get involved with all that.
It's funny, my aunt and uncle decided not to have kids, and I was having a conversation with him at some point. And what are your hobbies? And I said, see those two little girls running around in your backyard? Those are my hobbies. They consume every free moment of my life. And as they get older, less and less, which is, I'm happy for them, a little sad for me and my wife. And the other thing I couldn't agree more with, my wife always says, I don't care, and she does care, but she goes, I don't care about your grades. I care that you're a good kid. And that's when we go to her high school and ask, how's she doing? What we want to hear back is she's a great kid. Yep, she got a B+. That's fine. She doesn't have to be a straight A student as long as she's a good human being. So Mike, if folks want to learn more about you or Big Mike, your podcast, or Tempo Family, what's the best way to get in touch?
Now it's going to get super easy and super cheesy. So bigmikefund.com. Just like it sounds. If you misspell it and you forget the D at the end, you go to bigmikefund.com. I promise it's not a kinky site. It's the podcast site. It's an entry point. It's not our corporate website, but once you go there, you can go to the corporate website and you can look at our deals. But because of the podcast, bigmikefund.com, it's a good start, entry point, easy to remember.
All right, Mike, thank you so much for your time today. It truly was a pleasure to have this conversation. I'm glad we met, and I wish you continued success.
Thank you.
This has been The Real Estate Underground. Don't forget to rate, review, and subscribe. It helps us grow. Until next time, Undergrounders, remember your real estate journey begins with a simple step forward. Now get to it. Bye for now. This has been The Real Estate Underground. Don't forget to subscribe. It helps us grow. Until next time, Undergrounders, remember your real estate journey begins with a simple step forward. Now get to it. Bye for now.